And so that often the markets can sometimes discount
They have to lay employees off in order to keep their bottom line the same.
Yeah. And I still think it's hilarious because at the end of all of this, what are we doing? Like we're conjuring explanations for why people are buying or selling. Right? Like this, it's a dirty thing about the markets. But everybody talks like they know what's driving the supply and demand. Like, well, we just know that because of these earnings, the stock needs to go here. And that very saying that is akin to saying, well, let me try to influence some of the people looking for a reason to buy.
Like, which way is the wind blowing, right? Maybe we need to have a bucket every time we try and predict the future. We have to put $1 in the bucket.
Oh, goodness. So, can I have the bucket? All right. It's not the greatest Tuesday you've had all week because it's a different day and we're not in the studio. But
it's a makeshift studio.
We are in a corner of my office and we'll see where it goes from here. But Matt, thanks for carving time out of the schedule so we can do this.
Good to be here.
Yep. I always, the radio days are fun, but you also get constraints on the radio that we don't necessarily have out of studio. Right.
And we can edit this. The video is
it's
live.
It's not live, so I will take all of Matt's F-bombs out and we will clean it up for you. Anyhow, we've been really playing with the idea of what kind of themes would be valuable for the folks that not only listen to the radio show regularly, but also our clients, and then the folks that maybe become clients. And then there's just the folks that are just out there in the social sphere trying to learn and figure out getting ahead on this. We're looking for different thoughts and opinions on it. And, we're still early in the game for 2024.
Well, we've had a big roller coaster ride for multiple years now.
Yes.
2022, 2023, they were very, very different years. 2022, we have this huge, downturn in the markets. And then 2023 gives it all right back. And it created what seemed like a lot of panic.
Yeah,
for a basically flat market over the last 2 years.
Well, it's crazy because if you just fell asleep and woke up, 2 years later, you're like, what?
Exactly.
Yeah. And then meanwhile, you go, well, let me tell you all about. Mm-hmm. So it's been a wild experience in the markets. Here's a couple of key takeaways that I think are useful to frame up one we've seen up here, and then 2024. Some things, I don't know about you, but some things I am starting to look for as a money manager, right? Money management, when we're stewarding monies, retirement plans, and so forth for our customers.
Things that you're looking for to make sure to try and keep the ship on track.
Yeah. And what are the themes that I think may impact the markets and so forth? So first of all, the one that really just kind of blew my mind is the 2021. Which was this, we had the world changes in 2020, right? Whole world changes. And it's interesting because it feels like regimes ago, and yet it's just a few years. But in 2020, we break everything. The printing presses spool up. We go nuts. Markets first they collapse, and then they reflect.
Really short rally back too.
And so it ends positive. And then 2021, though, the S&P is the interesting story, right? Huge year, right? It's up really big, 30% or whatever it was, close to that.
And it's been a tech trend. It was a tech trend that year.
That's the key, right? Yeah. Well, we get this bit of research back and we're looking at it and says, hey, if you were to take the top 10 stocks on the S&P 500 in 2021, the returns for the index would have been negative.
And I was looking at 2023. It was basically the same story.
Yeah.
You have your major companies that are carrying the index.
Yeah. And this creates a real strange dynamic because here's the challenges that I think, speaking on behalf of our firm, right? Other money managers may be different, but one of the challenges that we ran into is we have different investment strategies and we mix and match them for our customers. And it's built around sort of their time horizon and risk tolerance. And then it's built on different rationales. Yeah. So for example, we have a strategy that really focuses on dividend paying stocks. We have another strategy that's designed to be very low volatility. So it's buying mostly big companies, but they're companies that have really low volatility. So we call those low beta companies. And so that's a different strategy. And those two had done really well in 2022. In fact, the low beta strategy had done, I think, the best in 2022 when everything else was struggling. It was actually pretty decently positive, nearly double digits for the year.
Yeah, I think it finished around 11 in that range.
Yeah. So you think, wow, everything else is struggling. It does well. And then we see 2023, flip the whole thing because we have a growth model that's built on sort of current momentum and growth. It does really well. You know, it actually outperforms the S&P 500 for the year. And again, I'm not going to throw all the documentation in here
So you're focusing on the trend.
Let's not talk so much about, here's the numbers. We're not selling performance. That goes away.
Yeah.
It's about the issue was we were able to lean into tech and certain of the key big players. And we had those in our portfolio and yet some really good buy opportunities that we got in at great prices. You know, when you see a company like Apple up over 40% for the year, this is one of the biggest companies in the world. And it's up 40%.
Mm-hmm.
And so, and it was in our investment model for that. So everything looks pretty rosy in that one.
Mm-hmm.
But the low beta model and the dividend model are just sucking wind.
Because did it have any tech exposure all year? Maybe a little bit.
Yeah.
But it was very, very minimal.
Nominal. And so it really kind of speaks to how the index returns have been driven by a very narrow sleeve that became disproportionately large, in my opinion, right? Because I don't know if the S&P is a very reflective of a balanced investment strategy.
Right, because it's the sector of technology is so prevalent, so heavily weighted.
Yeah, which I'm just telling you now, I have this theory. I don't know when it happens, but I think in the near future, tech stops being tech as a sector and starts becoming categorically different types of tech. And we make the sector delineation in the indexes more granular in tech because it's just too big of a category now. And it's too big of a single category for our economy, right? It's so much of a categorical contributor to GDP. Right. So it's just disproportionate as an employer. It's disproportionate as a portion of GDP. And so I think that, we're going to end up seeing it carve out more.
Right. And so how do you frame that up looking into 2024? Is there any big takeaways that you have looking back at the last couple of years and seeing the sectors kind of walk and talk the way they have?
Sure. Well, first, if you think about 2024, this is election year.
It is.
Right. Yeah. And so I think that it's hard to ignore that the reason it matters is not the election itself, but there's some real competing interests that seem to be on the ballot. I'm not a political scientist. I got a lot of opinion about it, a lot of opinion about politics, but so do we all, right? If I had this distill it looks like we have the camps are less about Democrat and Republican than they are about sort of a populist nationalist versus a globalist populist. No, they're both populist right now, but globalist meaning, hey, let's try to coordinate our efforts with all of the other countries versus more of a nationalist who's like, let's just focus on the domestic agenda. And this is the one that you hear people say things like,
it feels like we tilted a little bit more globalist.
Well, I think the current issue, I think the Biden administration, love them, hate them, whatever. I'm not really throwing rocks. I'm good at that anyway, but we don't need you, right? It's been more of a globalist approach. Like, hey, we definitely want to consider all these other countries. And, so you look at just how much money is being sent overseas to fund other wars and so forth. And then you have the conversations domestically about, wait, we have homeless issues. We have border issues. We have Veterans Affairs issues. We got this whole host of domestic issues that we're sending all this money overseas and we're saying we can't afford to fix this at home
here. Yeah.
You've got student debt, you've got mortgage debt, you've got consumer debt. And now we're even starting to see indications that people are going to be unable to pay their taxes, which is going to create a now issue where printed money to drive an economy to help pay for things so that we have a bigger economy, to have more tax collections that we can't collect.
a downhill spiral of sorts.
There's just a lot of social issues that are broken. And I do worry about academically how we're in the ethical capitalist church. I believe in capitalism. But I think that if it's completely unchecked with a moral conscience, it's not the job of the markets to figure it out, but the players in the markets to figure it out. Right? I think employers shouldn't be looking for exploitative wages.
Mm-hmm.
I think they should be looking for the right balance in the marketplace, but they should be viewing their employees as investments rather than employees as expenses. That subtle shift does change the way economies operate. And, but, I don't think it's the government's job to make people do that.
Yeah.
I think we have to do that. The government cannot come along with a big stick or a gun and say, be ethical, right? Right.
There's loopholes, and the big corporations are going to find it.
Well, and you can see the big corporations, this is the globalist argument, right?
Mm-hmm.
Well, hey, we can have our product made somewhere else for cheaper and bring it back. And the capitalist says, well, yeah, I want the cheap price.
Mm-hmm.
And if you don't, then why are you buying it from the cheapest provider? Right? So that's the competition side of it. But, anyway, we digress. What does it mean for the markets? And so,
how do you see that shaping up? I mean, you said people have some vested interest in the elections and the markets. So how does that kind of walk and talk with each other?
Well, my sense is that you get two really different policy directions depending on who ends up in office, right? And
again, so do you see it driving your markets more towards the later part of the year, or the election cycle having some influence on the markets leading up till November?
I suspect that what we'll have is continuing the current trends somewhat, right? I actually think the underpinnings of the market are decent. Like, you can actually look at the data and it would suggest there's a lot of indications that if we don't successfully have that we may not get the soft landing that Fed's hoping for,
mm-hmm.
right? And like his history has kind of shown that hasn't really been pulled off well.
Right.
Oh, we're going to get it just right, and we're going to get things to slow down without having a recession.
Right. Because the market, it looks like it's kind of been pricing in a few rate cuts for this year. One of the things that I found interesting, just looking at some of the bond pricing, is yields are starting to go back up. They fell off really hard for the last 30 or 40 days. And we're seeing that yield starting to actually go back up. And we've seen the markets kind of had some headwinds. So it'll be interesting to see,
let me ask you. So just for everybody that's watching or listening right now, what's the significance of that change in yield?
Well, if the yields are going back up, it indicates that we might not be getting all of the price or all of the interest rate cuts that they're projecting. Mm-hmm. And if we don't get those cuts on the interest rates, the market might have to correct for kind of pricing that into the equation.
Sure. So, and again, I'll use some different phraseology to say similar stuff, right? Which I talk about cost of capital, right? And the cost of capital is just this financial term for saying, well, what does it cost to borrow money, right? If you're going to go buy a house right now, it's like, well, what's your cost of a mortgage, right? That's your cost of capital. So you can buy more house when you have a 3% mortgage than when you have a 7%.
Basically, if the interest rates stay higher, it's going to not promote people to spend as much because it costs more to borrow money. Yeah. And that slows the economy down. Right. And with it kind of drags the markets.
Yeah. So they're headwinds because money's expensive.
Right. We're kind of getting a little bit of that right now.
Mm-hmm. And we would expect when we talk about yields, that's remember, like a bond, in essence, is you loaning money.
Right.
Okay. So if you purchase a bond, you are lending your money to another, whatever it is, whether it's a government entity or a corporate entity or a municipality, which is still government. But, you make the loan, they pay you interest, or you buy it at a discount, and the interest means the price goes up to face value and it matures in the future. And that face value is the balloon payment that you get at the end of the loan. So that's how a bond sort of functionally operates. And the market's telling you, well, if yields are going higher, then that would mean that somebody else is willing to pay you more to borrow your money. Okay. Now, if you've already loaned your money out and somebody else comes along and they're willing to pay more, and you want to get that money and go get more over here, you have to sell your bond to somebody else. And they're going to look at that and go, that's not nearly as attractive. Why don't I go straight over there and get better rate?
So they have to cut the price.
So you got to cut the price in order to get it sold. And what are you going to do? You're going to end up cutting the price until it basically is the same as the equivalent you get somewhere else. So you do have the value of your bonds can fluctuate between when you purchase them and when they mature, and it's affected by interest rates.
Mm-hmm.
But it's the opposite effect, right? Rates are going up, then your bond price is going down, and the inverse. So I think it's interesting is if there are going to be rate cuts in the marketplace, then bonds should become more valuable.
Mm-hmm.
But what we saw was the opposite. They were trending down, and then recently we've seen that shift again.
Right. And we're seeing tech also trading at kind of some all-time highs. I mean, I'm quoting that, but you would think that given enough time, we would see it kind of digress and get back more to the meat of the trend over multiple, months and years.
Right. And there's a lot of things that play in that if you get into the mechanics of it, because we don't talk very often about it because it's usually better to have like graphs and stuff.
Right.
And that's not the format today. So we're going to put something on screen and go, oh, well, look, here's what an overbought condition looks like. Although that's sort of what's happening in tech is you have a couple things going on, right?
Well, what's spooky is it is trading high and it comes down a little bit if the indexes are often overweighted to tech. That actually can drag things down pretty quickly. And so
you can see the market, again, air quotes,
right,
because these major indexes are tech heavy.
Yeah.
So you get a few of the tech companies go in the wrong direction and the whole index starts to decline.
You could think about it too. What if 80% of the companies that aren't tech are doing okay or slightly positive and tech's not doing well, even though most of them are doing well?
Yeah.
You could see negative returns, and that's weird to think about.
I always come up with these goofy mental pictures, but tech is kind of like in a solar system. Tech is like the sun, and everything else is revolving around it right now. And so it's just this massive gravitational force holding it all together. But what if it changes? Well, everything is going to get knocked around with it.
Yeah.
So tech is clearly wagging the dog of the market right now. And here's the other thing: tech is interest rate sensitive, right? If you think about a lot of these growth companies, so tech falls into this typically.
Like they thrive on cheap money.
Yeah, well, they don't pay a dividend to their investors because what are they doing, right?
They're investing back.
Yeah,
they're trying to try and grow.
Yeah, the profits are coming back in. And so what they'll do sometimes is they'll maybe issue a bond because they're growing fast enough. Like, well, it's cheaper for us to issue a bond and then get investor money to grow that way than it is to reinvest in the company or whatever it may be, or borrow from the bank, right? We'll borrow from in a bond because this is Apple's story, right? We have great credit rating. We can finance our dividend because we pay a dividend here, but we can borrow for cheaper. So it makes sense. But if you think about companies that are growing, then if they have to pay more to borrow too, that's a headwind for them. And so that often the markets can sometimes discount.
They have to lay employees off in order to keep their bottom line the same.
Yeah. And I still think it's hilarious because at the end of all of this, what are we doing? Like we're conjuring explanations for why people are buying or selling. Right? Like this, it's a dirty thing about the markets. But everybody talks like they know what's driving the supply and demand. Like, well, we just know that because of these earnings, the stock needs to go here. And that very saying that is akin to saying, well, let me try to influence some of the people looking for a reason to buy.
Like, which way is the wind blowing, right? If you need to have a bucket and every time we try and predict the future, we have to put $1 in the bucket.
Oh, goodness. So can I have the bucket? I just know that even everything that we're doing is about trying to assess where the majority is going to be driven from a supply and demand.
That's part of the job. That's a big part of the job.
But it's still, at the end of the day, the best you can get to is an educated guess, and it can be wrong, right?
Because that's what no one really wants to talk about, though.
Yeah.
Right.
Well, because it's not just like what's Apple? This is not a recommendation, but let's say this big company and they came out and say, we're going to have a bunch of iPhone sales coming up. We got a new product line, some knock your socks off. And then everybody that's looking at the pre-releases are like, it's going to be amazing. You got to have this thing. And the world lines up for that. And then it's released and people are buying it. But then something else comes along like, well, now there's a satellite phone. And this thing's totally irrelevant. You can have coverage anywhere in the world. You don't just need it.
And it's $5.
Yeah. And we're going to, sell them for half the price of an iPhone. And everybody goes, I no longer, the whole demand landscape changes. And everybody says, I quit. Apple's useless.
Mm-hmm.
Or, Apple, it turns out, has been, I don't know, stealing or something. And everybody's like, well, it's toxic. Never mind. Radioactive company, not going to own it. It's poof. The whole thing changes. And we have all the reasons that it shouldn't. I mean, what happens if, what if holding a cell phone to your head causes brain cancer?
Yeah.
Like boom. What? It's a mess. And I hope that's not the case, by the way. What a terrible thing, because I'm going to be guilty. But anyway.
People are bit by it.
Yeah. And that's the reality is that we consider and say all of the reasons that these things should happen. But what they are is just data fitting to an outcome, right? I don't know what's going to happen. I just think it's going to happen. But, and here's something that we're going to talk about. It kind of depends on how many people show up for the day in the market.
Yeah. If there's no one really showing up to buy anything.
Well, what if just nobody shows up at all, except for like 2 people? This is ridiculous. But, so everybody decides, we love Apple, but you know what? We're not around and there's no news at all. There's only a handful of people. One person says, I need to go buy, this is a dumb example, but just put it in your head so that you get an idea of how extreme this can get. One person comes along and says, I'm going to sell all of my Apple stock because I need to go get started on this house I'm going to build. But everybody else in the world doesn't want to sell their Apple stock, but nobody wants to buy it either. Right? And now you got one person willing to sell, who has to sell, and nobody else is willing to sell. But there's nobody that wants to buy right now. I don't know why that would ever happen, but what would happen, right?
What about, I think a good example would be a really thinly traded stock.
Yeah. Well, yes, but in our example, you just follow through to the end of this, right? Which is, if nobody's willing to buy it at the price that the only person is willing to sell it, they're going to lower the price.
Mm-hmm.
And if nobody's willing to buy it there, they're going to lower the price. And they're going to keep lowering the price because remember, this is an auction, but it's an auction that works both ways. How many buyers on the way up? Nobody else? No more? Oh, we'll go a little lower. Anybody there? No? Okay. And so it's constantly trading back and forth, matching buyers and sellers. If there's no buyers and you have to sell, that price drops and drops and drops and drops and drops until finally somebody comes along and goes, what would be kind of an idiot not to buy that? What would be that situation? Oh, well, you know what? If Apple went bankrupt and we just collected all of their real estate and everything like that and sold it for 50% of the value of the market, and it's, we can recover that and say, well, the stock's cheaper than that. I may as well do it. So there's an example where there's just no buyers. And so the next price that shows up is the last price that Apple trades for. And then it's half the cost of what it is today. And all of a sudden the value of Apple is reflected as half what it was for everybody that owns it, because there's no other buyers or sellers matched. And that's the last price we saw.
Mm-hmm.
And you're like, wow, it sucked. But is that really the value of Apple? Or is that just a snapshot in the moment of the trading book dynamic for that moment?
And we see this all the time, right? Like an XYZ company, there's a news report that comes out and the news is really negative. Mm-hmm. And if there are a bunch of people that get scared, panic, and are selling, and then no one shows up with the guts to buy, it does the exact same thing that you just talked about. It keeps bringing up.
This literally was 2008. Okay. When in 2008, there were banks that owned illiquid assets and I think it was the FDIC that came along where they were auditing the banks to make sure they had enough capital reserves for the loans they had out. And they came along and said, we need to know what the value of your collateral is. They said, here it is. And they go, that stuff's illiquid. We need a market value. And they looked and went, it's not going to mature for like 5 years. What do you mean? And they're like, well, what is it worth if you had to sell it? And they go, oh. So it was called mark to market. They needed a price. And so they had to put it up. Well, first of all, they had their prices of things that followed, and they had to put they had to take this illiquid collateral, put it on the market, and say, will anybody buy this? And everybody said, mm-mm. And then they said, well, will you buy it for less? Mm-mm. How about even less? Mm-mm. How about really, really low? And they went, okay. And then that became the value of the collateral. And all of a sudden, shoot, we don't have enough collateral to match to our loan obligations. We're undercapitalized. We need to get money somehow, or we have to start selling off other assets. Well, assets to banks or loans too. Mm-hmm. So we just start changing our balance sheet, and it just created a negative cascade, and everything just, because all of a sudden the collateral started to destabilize. You think the dominoes fall in their own direction. It's a hot mess, man.
Yeah.
Yeah. I don't ever want to see that again, in my lifetime, but who knows? Yeah. So anyway, all this to get back to this year, right? Mm-hmm. I don't think we have that same collateral crisis because, frankly, the Federal Reserve has stepped in and said, printing press.
Well, yeah, it almost feels like we're more repricing things to all of the money that we print.
Yeah. Talk more about that.
Well, if there's a lot more money in circulation and a lot more money that exists, things have to adjust to their new values, right? And so I think there was a statistic that said 25% of all the money that exists was printed.
Like in the last 2 years.
Yeah. So your cheeseburger that was $6 has to get repriced to $8. And that's part of why we've seen inflation. But these companies, the value of the company also has to change. And that affects the share price. And so we could see share prices move higher as people are trying to recalculate what these companies are worth.
Yeah. I had this really odd thought the other day about how we look at the price of things. And a lot of us would anchor our price to something we know. I joke about like the Snickers bar next to me. So when I was a kid, like a Snickers bar was about 40 cents, right? And today, like my kids are like, well, like a Snickers bar is like $1.50, right? Mm-hmm. That's just the price of a Snickers bar. And in a sense, that is completely like how the system works, right? As well, right? This is a whole different generation.
If they say it's $1.50, it is worth $1.50.
Well, and here's part of the key though, right? Some of the things that have changed over time, right? Do we actually get more Snickers bar per labor unit, right? So like when somebody goes to work, are they making more Snickers bar now than they were 20 years ago? And maybe a little bit with like robotization and so forth. And so they might not need as many employees, but the productivity per worker has changed a little bit with modernized tools. But we've also seen an increase in minimum wage and the cost for the labor. And so if labor costs are going to be higher, the market largely reprices that.
Right.
And so, yeah, you print a bunch of money and then you change labor prices.
The labor prices have been a pinch point in a really bad way.
Well, labor prices are absolutely,
we have a shortage of workers. We keep hearing about that, right?
And that's, man, we can't cover that today because we had a bunch of people that are like able-bodied and in the right sweet spot to work. And they don't.
They've exited the workforce and
like permanently.
Yeah.
As I said, something like 7 to 9 million men between the ages of like 22 and 59 have permanently left the workforce, and they're not disabled. This is like a micro statistic. If you like,
the question is like, how are they affording this?
Yeah, I don't know how they're making life go. I don't.
We have also though upped a lot of the government programs.
Yeah, but I don't know if they're even getting money in those programs or not. It's just, what does it mean when you have culturally a whole group that abandons work? I don't know how. Like, I still see this a lot to this day. I mean, everything's more expensive. And you have people, well, now they're starting to hear like there's not jobs to be found. right? For a while, it was, we can't get anybody to work. I still hear companies say that, but you also hear people say, well, there's just not as many jobs as there were.
Well,
I don't know which is true.
I think it might be partly that because as things have gotten more expensive and inflation has hit companies, they've had to adjust to, working with less people.
Mm-hmm.
And so as the companies have figured out how to keep the ship afloat, they figured out how to work with less employees.
And is it just, there's so many things that are going on at the same time, right? The whole work from home trend that's starting to change, right?
People are getting called back into office.
So that was a whole, like, how are we going to price that in? Are you working from home now? And, whether we like it or not, there's some pretty good evidence that in some cases, not all, in many cases, working from home, productivity declined, teams were less efficient, things didn't work as well. And it costs more sometimes. So, certainly if you pay the same but you get less productivity, that's a drag on the company. So you can see the attraction pull it back in. But you've also seen the effects it's had on the commercial real estate market. That's kind of a time bomb for the banking system.
I think a big impact was people's mental health. I mean, we saw a lot of people mentally really struggling with working from home for extended periods of time and not being able to be social with people.
Yeah. Then how about the education system and how that we have a group that just had a whole chunk of their education more or less skipped.
It was.
And they're, we can look.
I was there.
Yeah, you were in the classroom.
Yeah.
It's not I don't care who caused it or this. It's just, it happened. Right? It happened. And so we can say, because this person sucks. It's like, whatever. It happened.
We just got to realize it did. And then what are the repercussions?
Yeah. I just don't want to pretend it didn't happen. Sometimes you get the group that's like, well,
we'll make up for it.
Please.
Too. Yeah. You hear that one. We accelerated their learning and filled that gap. And I'm like,
where you really see it? This is going to sound so petty, but at the same time, you can't hide from it. You saw it in athletics, right? You really saw
players that got the 6th year to figure.
Well, in high school though, and you're seeing the classes that the juniors and seniors that didn't even get to play, and so they just didn't develop the same skill set. So the quality is lower as a average than it would have been had there been more games for everybody to play and been able to carry through. So those are real impacts that we can pretend it didn't happen, but the evidence is right there. You can see it.
We see it in a lot of areas. You look at the life expectancy in Canada. They had an interesting statistic on this. They were showing a chart where the average life expectancy kept growing, and it did it for 30 or 40 consecutive years.
Mm-hmm.
And you had COVID come around, things shut down, and life expectancies have fallen for 3 years in a row now.
Yeah.
So
I understand they've stabilized again somewhat.
A little bit, yeah.
And I don't know.
Had an effect.
Yeah. Well, here's the real question, right? Underneath that is, did they actually change, or did we change how we recorded life expectancies?
Right. And I'm like, is the data really accurate?
Yeah. Well, this is the whole thing. For a while, somebody dies in a motorcycle crash, but it was COVID, because everybody was getting more money and reimbursement if it was a COVID-related death. So any way you could justify COVID was in there. It's well, I'm pretty sure there was somebody with COVID in that town and he drove by. So clearly COVID got him. I mean, I know I'm being absurd, but that kind of stuff was going on.
It was manipulated. Yeah.
Yes.
And so the numbers and their accuracy, who knows?
Yeah. I think that's kind of my big beef with a lot of numbers. The whole, we talked a little earlier about the idea of overbought and oversold.
Mm-hmm.
What that really is from a numbers perspective. It's mean reversion, right? It's the idea that, there's a normal distribution here. If you get way far outside of it, the probability is you're going to come back into the middle of that distribution. And, what we saw was COVID, I feel like maybe those aren't real numbers anymore. Because how did it get so skewed? It's we had a pandemic. Yes. And we also created some real leeway in how we recorded data because we incentivized it with, we want the dollars associated with it.
Got to follow the right trail.
Well, but this is part of that inflation trail too. right? Everybody that's like, oh, well, it's just money from the government, right? This idea that federal money is free. Like I hear states talk about it, municipalities talk about it. Lots of nonprofit organizations. Oh, we got a federal grant. That's free money.
This is how Washington D.C. operates, right? Like, just print more.
Yeah, it's like the money was not free, right? We have this unbelievable debt, right? Unbelievable. When we were, what was it? I mean, how many miles high would it stack? It was like 7.5 miles high. If you took $100 bills and stacked them to get to our national debt.
Oh, it was much more than that.
No, you're right. It's like 75 miles. It was would reach satellites in space. It was crazy.
It was a lot.
Yeah. It was higher. Like, the normal passenger plane flies here. It's like, we'll go orders of magnitude above that, right? So, I don't think people have an understanding of how much debt we have.
No.
I don't think I have an understanding, and I'm looking at it and working at it. So, how do you do that?
And yet, the economy still continues. The markets have still continued to do their thing.
Yeah.
That's what a lot of people don't want to talk about.
Well, and here is probably the 2024 reality check.
The synopsis, yeah.
The reality check is the system for all of our complaints about it, right? We can complain about who's making the decisions, what the decisions are.
We can complain about the debt.
There are, but we can also acknowledge, right? There are structural problems in the system.
Sure.
It costs more and it takes longer than it should for a lot of things. And those reasons have been compounded over time. And, we have people in government positions that we can't get rid of because the system won't allow it. And there's broken parts. We're not pretending that's not the case. And yet, I believe that with the exception of people that are like so far outside of that, there's always going to be a group of people that if you tell them, hey, don't go out in the cold without a jacket. They'll go out in the cold without a jacket on purpose because you told them not to do it, right? Hey, don't go hurt yourself. Fine, I'll hurt myself. There are those people. If we take them out of the equation, I can't think of anybody that doesn't want the system to survive.
Everyone wants the markets to go higher
because
basically everyone's invested in it. And it's in no one's best interest for this to completely fall apart because then everyone loses their money. People don't want to lose their money.
Right. And even the folks that are like really impractical, like the prepper mentality that says, I keep a bunch of money in a safe, hidden away in case the world comes to an end. And I look and I go, but if the world comes to an end, the government's the one backing the money and the government's gone. Why would the money be useful anymore?
Right. I'd rather have guns and bullets at that point.
Yes. I mean, it's like you want tangible goods and tradable things because we're going to be going back to a feudal system where it's like he who can protect and grow their crops and feed everybody and keep the onslaught of looters out is the place to be, right? So it's kings and castles again if we do that. And what goes your money?
So are we going to sharpen our swords and flock to our castles, or are we going to keep a cool mind, stay invested, and just ride the wave?
Yeah, I when you put it that way, I think you have to, at the end of the day, recognize there's going to be cycles in the market.
Absolutely.
Right. And this year, I expect to get, there's going to be a lot of inflammatory things said because, remember, somebody is trying to convince you to either vote or not vote, right? And then they want to know what you're going to do with that vote because that's how they're going to try and position power. And then if you're out there saying, oh, that's what you say, but the votes are rigged, I can't say that that's 100% false, but I can say that it's probably not true. I can tell you, though, you're easier to control if you can be triggered into an emotional state because it becomes like a reaction, right? Mm-hmm. So reactions are more predictable. It's like, oh, this person's going to do this, or this when they freak out versus, oh, the person that's thinking is going to weigh lots of stuff and make a decision. So I expect a news cycle that really ramps up. I think in the second half of the year, it'll get nastier. and we'll see people trying to position to make it look so bad for the other team that you vote against that.
People are going to play their cards.
Yeah.
That's a given.
Yeah.
So,
but if I think about where the market's at, I don't think that an election year makes it any more likely that the markets will decline. I don't think the markets would be surprised if we saw a recession start to occur.
Markets can surprisingly not care about elections. We've seen that before.
Information. So I share this with some folks earlier. I think the biggest difference between investing today and investing 30 years ago or 100 years ago is less about the way we value things or the cost of capital and all those elements than it is about the speed that information moves. Right? It just moves so fast.
Right, because the market moves on information.
Yeah.
And if it can get into the system and get to everyone really quickly.
Yeah, it can reprice quickly. And also the policy tools work faster. Right? It just took longer to filter things through the market. But with modern technology, we can distribute things so quickly. I think market cycles, and this is just my opinion, I don't know, but it's just my opinion is that market cycles just take less to unfold. Economic cycles still have more natural life cycles, but I think the stock market sniffs things out and reprices it pretty quick.
Well, maybe that'll help investors sleep a little bit easier at night.
Yeah, I hope so. And I guess this is that opportunity where, we do this for people behind the scenes. So every week, actually almost all the time, we're getting together. There are other team members that are not on camera here, but we're going through what's happening in the markets. We are evaluating what we're doing for our clients. We are managing money and making small adjustments along the way. They're called them just sort of course corrections. They're not usually big moves, but we track this stuff. And we try to fold it into the master plan, right? There's a whole financial plan at play here. For most of our clients, investing is to do a thing. It's not just to make more. So if you don't have a person in your world that's helping you with that and you're looking,
or you don't know your goals.
Yeah.
Then
I would say, for a lot of you, do it yourself. That's great, right? But for some of you that are like, no, I could maybe use a second opinion or some help, I guess give us a call. A lot of tools for that. What's our phone number?
541-375-0898.
All right. See, it's a test.
Yes.
Look at that.
Or email at info@littlejohnfs.com.
Okay. So we'll put all that on screen. Grab that, click it. Check out the webpage. A lot of other content out there as well. So feel free to get that. And I'm sure the next one will be on the radio again because we're usually a little bit goofier.
This was a nice change of pace.
Yeah, it's just a chance to talk about what's going on in the world.
Yep.
So if you've got questions, also feel free to fire them away. We're trying to pay attention to what our viewers and our listeners are saying and address those directly.
Content that people want to see, let us know.
Yeah. So and the whole goal here is help you learn, become better investors, and we'll go from there. So
I like it.
All right. Well, then I guess until next time.
Yeah.
Good deal. Well, I'm David.
And that.
And we'll catch you later.